a separation between there's monetary component of this, and then there's like a technology or like a corporate component of it. The monetary part, you have to be a maximalist, right? You're a fiat maximalist. If you're a US citizen, you get paid in dollars, you save in dollars, you invest in dollar denominated assets, you pay your taxes in dollars. So you're a fiat US dollar maximalist. When it comes to monetary assets, everyone in the world is a maximalist because that is what you denominate your wealth in, right? Very, very rarely does somebody say, hey, 50% is in this currency, 50% is in this currency. And so from a monetary standpoint, definitely a Bitcoin maximalist, because I think Bitcoin is the only one that has an opportunity to actually kind of ascend to global reserve status and end up being the superior monetary form. But when it looks at the technology, I think that there's going to be massive competition on that. So if you look at the technology side of it, where you're not talking about monetary asset, you're actually talking about a technology asset, it would be like saying you're an iOS maximalist, or you're a, Python maximalist, right? Depending on the language or the platform or whatever. So I think that you've got to be able to separate out and say, Bitcoin is competing with fiat currencies for store value, medium of exchange, etc.
And really fast, fiat just means it's government backed.
Just government backed, and basically they control it. So the key definitions here are a fiat currency versus, let's call it, sound money. All sound money is basically something outside of the system and something that people can't create more of. So gold is a analog version of sound money. It's a physical form of sound money.
Created by stars exploding. When I heard that, I was like, God, yeah, that really is an interesting way to think about why it's scarce.
Yeah. And Bitcoin is a digital form of sound money. And so you can compare the sound money to the fiat money. It becomes pretty clear pretty quickly to people. Is like, okay, one is completely abundant and can be created at will. 38% has been created in the last 18 months versus one that nobody can create more of. Well, I don't need to know much else other than that to know which one's going to end up being more valuable. And so if we look over the last 12 years or so, Bitcoin's purchasing power, and all purchasing power means is how much does it cost to buy, a good. The purchasing power has appreciated. It's increased. So all of the expenses around you, all the physical items that you buy have gotten cheaper and cheaper. So it used to cost me 1 Bitcoin to buy a loaf of bread. Now it might cost me 0.0001 Bitcoin to buy a bread. Okay, that's pretty interesting. The dollar's the opposite. Right? It cost me more dollars to buy the bread. So everything's getting more expensive around me. And so ultimately...
Hold on. Like that's so basic and so game-changing to understand. So you've done a mental switch where you now denominate emotionally in Bitcoin, aka Satoshis. Mm-hmm. And I haven't yet. Mm-hmm. So as I see the price fluctuate on Bitcoin or whatever, I get excited. Well, the funny thing is I get excited in either direction. When it goes up, I'm like texting my wife, yo, in the last 24 hours we just made. And she's like, you have got to be kidding. I mean, it's crazy.
Yes.
Now, when it goes down, I'm texting her like, yo, we're going in hard. Like we're buying this dip. So, but it's really, really interesting. Do you mind saying again the cost of loaf of bread compared to dollar versus Bitcoin?
So if I denominate my life in dollars, and let's say I buy a loaf of bread today and it's $2, 5 or 10 years from now, that loaf of bread may cost me $3, $4, $5, depending on the rate of inflation. If I denominate my life in Bitcoin, and today, let's say that it cost me 1 Bitcoin for a loaf of bread. In the future, it will cost me less than 1 Bitcoin. So it'll actually become cheaper for me to buy, because every asset, when you think of price, it's denominated in a currency. So a stock, right? When I ask you what is Amazon's stock price, you're telling me one Amazon share over how many US dollars. And that's how we get to the actual value. And so when you start to think about that, look at the stock market. The stock market from 1971 to today is up and to the right. It's a perfect 45-degree angle.
Oh, God, I know what you're about to say.
When you denominate it in gold, it's down since 1971. If you denominate it in Bitcoin since 2009, 2010, it has crashed aggressively. Bitcoin has been the best performing asset, but that's because it's denominated in dollars. And so ultimately what we're watching an entire generation of people wake up to this fiat currency kind of fiasco. And there's a famous, I think it's Henry Ford quote where he said, if people understood how money worked, there would be riots in the street before morning. And it's simply, again, it goes back to that education gap. And so the 55% of people who hold investable assets, whether they understand why or not, they're actually benefiting from this. And so it's important to remember that I don't think there are nefarious or malicious intentions, or let's screw people at the bottom of the totem pole. In fact, sometimes it's actually the exact opposite. But the system is working as designed. It's a feature, not a bug. And the reason why that's important to understand is because the system is not going to change, right? You and I are not going to be able to convince anybody to do anything different. They're going to do what they're going to do because that's the way the system is built. But what you can do is you can change the way that you're positioned. So you have a choice. I can either suffer at the hands of this system, or I can flip around to the other side of the table and I can benefit from the system. Every single rich person understands how to benefit from the system. Hold assets, not a currency. Don't hold the dollar, instead hold the assets.
Because that's one thing, it's to hold an asset that you have a reasonable belief is going to go up in value over time. And one thing I want to go back to, so you said, all right, the cost of the loaf of bread is going to take less and less of the Bitcoin that you own. That's a prognostication, right? You're hoping that that is true. But one thing I want to point out is the things that you're looking out into the future and saying that the bread will cost more dollars is backed historically. So it's simply you looking backwards and then carrying that out forwards. And the same is true of Bitcoin,
yes.
Is that you're looking at the historical performance and projecting it forward. It's not like you're just making that up and being hopeful. And that is where I think this starts to be important, is one, to recognize everybody has to do their own research. You have to figure this out for yourself. You want to understand it to the point where you're not thinking in analogy, you're thinking from first principles, so you understand how the game works. You're, emotionally rioting in the streets, as Henry Ford predicted. But yeah, I think that's an important thing for people to understand. This isn't hopium. This is looking at the historical performance. And in fact, one of my favorite statistics, and strike me down if this is inaccurate, but that Bitcoin, and this I got from Raoul Pal, that Bitcoin is the fastest adopted technology in all of human history.
Yeah, it depends on how you count, but for sure. And remember, price, right, is kind of the best indicator of adoption. If you have a fixed supply asset and demand for something or adoption for something goes up, the price has to continue to move upwards, right? Just more and more people want this scarce asset, and so the price goes up. Bitcoin was the best performing asset over the last decade.
So now, all people talk about is the volatility.
Well, volatility actually, and this is like where you get a little bit more in the weeds, can be very good for a portfolio. So there's this data
because you have potential massive upside.
Yeah, so there's two kind of ways to think about volatility. We think of volatility when it's talked about in the mainstream media as a negative thing, right? Oh, it's volatile, it's volatile. Well, if something goes up in value, it's volatile to the upside. If it goes down in price, then it's volatile to the downside. So volatility isn't good or bad. It's just, is it going in your direction or not, right? If you're short an asset and the asset goes up in price, you hate volatility, right? Because you want it to go the other way. So volatility being not good or bad is important because you want it to actually be volatile if it's going in your direction. The second thing is, I think that this data may be, I think it's 2015 to 2020, and don't quote me exactly on the dates, but there's a 5-year period where if you invested in a 60-40 global portfolio, 60% stocks, 40% bonds, you got a 7.2% annualized return for 5 years. It's about average where we've seen it over the last few decades. If you had taken 0.5% from stocks and 0.5% from bonds, so you had a 1% allocation to Bitcoin, 39.5% to bonds, and 59.5% to stocks, you would have taken that 7.2% per year and increased it to 9.2. Wow. So a 200 basis point increase in your annualized return. If that 1% allocation to Bitcoin had gone to zero, you lost all the money, you would have only gone from 7.2% to 7%. So it's about a 200 basis point or 2% upside for a 0.2 or a 20 basis point downside. So 10 to 1 during that 5-year period. Now, the reason why I say that is 1% of a portfolio is not a lot of money. For most people, that's kind of a speculative type investment. But because this is so volatile, because it has the ability to appreciate so aggressively, like you talked about when lots of people are getting excited, et cetera, is it can have a really profound positive impact on a portfolio. And still, you only have exposure of 1%. And so we just haven't seen that many asymmetric assets like this before available, kind of in a liquid market for people to go buy. And what I think ends up happening is people come in because of the price. They're like, oh my God, I'm going to get rich. This is amazing. This is like the greatest thing ever. It goes up in price over time, whatever. But then what happens is, as my friend Marty Ben always talks about, he's like, you come for the money but you stay for the money. And you came for profits, but you stay because you start to understand fiat currencies, economics, personal finance, etc. And you start to realize, wait a minute, I have to do something. I can't sit with cash. And so it's just a very unique asset that we're all kind of living through global adoption, right? We've gone from the creation of an asset 12 years ago to now there's a nation state that has bought Bitcoin. I don't think anyone, 10, 12 years ago thought that a nation state would buy Bitcoin this quickly. And so going back to Raul's point, you're building all of this on top of the internet. And so the internet adoption happened on top of the telephone lines and kind of the connectivity we had. So it had a certain rate limiter to it. It could only grow as fast as we had, communication infrastructure. Now when this gets built, it's being built on top of the internet. So look at what is the total internet penetration globally. Well, that's the rate limiter for how fast this can grow. And I don't think we probably talk about it enough, but there was immense work done in places like South and Central America, countries in Africa, places like India, etc., China, to really drive internet infrastructure over the last 15 years, right? Everyone from the Googles, Facebooks, Amazons of the world to kind of the traditional internet providers all spent billions and billions of dollars getting all that infrastructure installed. And now here comes along a technology that is literally just going to ride the coattails of that internet infrastructure and get adoption. And so that's where you see countries like Nigeria and others that you wouldn't think of being, super forward, kind of thinking on technology. They're actually some of the highest penetration and adoption. They have the macroeconomic problems of the currency, and they're watching their currencies get devalued. They're watching the dire financial position they're in, and they have the internet infrastructure now. And so they're not tied to a legacy infrastructure financially. So what do? They leap forward a developed country. And I think El Salvador's got a shot to do that. I think Nigeria is going to do that. And so we're just watching, a tale as old as time. This has happened over and over and over again with technology trends. It just so happens that now it's coming for finance, and there's a lot of powerful, influential people who don't like that.
Yeah.